Hi everyone, welcome so much to our webinar today about the fundraising mindset. So today we are going to be sharing a little bit more with you about how fundraising can impact your mental health, and we're delighted to have Daniel with us today. So Daniel has successfully raised funding for several of his own startups and helped many other entrepreneurs secure investment across multiple industries. And today he'll be sharing his insights into the emotional side of fundraising, including how founders can prepare themselves to stay resilient, remain focused, handle rejection, and avoid burnout throughout the fundraising journey. So I'll pass it over to you, Daniel.
Thank you, Annabelle. Great to be here again, and a topic I particularly like because it's super relevant to founders out there, especially those who haven't been through the process before. I think there's a lot they can learn, and I think it's also not always the rosy story that we see and hear about in the news, and there's a few home truths. I've also failed to raise funding previously, so I think there's a bit of experience I can use to share with people. But I think the headlines are great. There's a lot of money out there, and especially with AI being such a driving force, startups are raising rapidly and increasingly large rounds. So it's exciting. However, one statistic that hasn't really changed over time is that the vast majority of startups that go for fundraising actually don't get the money, and that's a challenge that they need to face, and a reality that shouldn't put them off, but they should understand what the process looks like, from a time perspective, process perspective, but as you said, especially mental challenge perspective. So today we'll explore what investors look for when they're having fundraising conversations, what increases their confidence and decreases their confidence, and why founder mindset has kind of become a very big topic when it comes to fundraising, especially for those early stage startups where there's less traction and the business isn't yet formed, really. So looking forward to this one.
Absolutely. Apologies, I'm having a slight technical difficulty. I just need to get my screen shared. Won't be a moment. Do apologise. And then we can move on to the next slide. But yes, really excited about this one myself. Certainly something I haven't actually been through the process yet, but something I'll probably be looking at myself in the near future. And so important to kind of have a real world perspective and understanding of what to expect when you're fundraising, beyond kind of just what you need to do, the kind of the ins and outs of everything. So yeah, really looking forward to this one myself. So do apologize. I will be with you in just a moment, and I will be able to move on to the next slide, I hope, in just a second.
Your technical glitch is a perfect example of something that founders probably face when they're pitching or doing demos. The ability to sometimes handle that unwanted and change of direction.
Yes.
It's that ability to think on the spot is we've all been there before. We've all been there before. The technical glitch.
The technical glitch, yes. There we go. 1 second. Almost. We'll be with you in just a moment. And let's get should be sharing. Why is it not sharing? Share screen.
I can see the screen, by the way, Annabelle.
Yes, but that's not my
my
slides, unfortunately.
I can
there
now
we
see
go.
the one.
Brilliant.
Okay, so let's dive straight in. The founder psychology during the fundraising process. Founders will experience a lot of different emotions, and I think one thing that's really important to stress here is that when you're pitching um, to investors, actually the financial aspect is often not the most important. The emotional and psychological process and what the investors think of you as a human being, personality, and your traits can be more important. Again, especially when businesses are an idea or only a couple of months or a couple of years old, um, the investors put a lot of weight on the founders. And founders have to be ready for that because they're being analyzed, they're being judged, and they're also dealing with their own emotions and their own challenges. So we often hear about fear of rejection is something we come into, happens to all of us. Pressure to perform. You know, you're on the stage constantly pitching. And again, you're not just pitching a business idea, you're pitching yourself.
And things go wrong.
And things go wrong, as we saw. Having self-doubt, you know, not just in your pitching, but your business idea and your business process and how you're going to take to that challenging aspect from other people sitting opposite you. And generally uncertainty, because the life of startups is all about uncertainty. And so what tends to happen is you've got an idea, you've got it off the ground, you've built some momentum, you're excited, you're super positive, and then you go and start speaking to investors, and you might find that there's a lot of rejection. In fact, even startups that have raised millions and billions often cite their initial fundraising process involved tens, if not hundreds, of rejections. So that emotional pressure and constantly being told maybe the idea or the concept or whatever it is, or you're not fundable, is something you have to deal with, because all of that will affect confidence. It'll affect your communication and decision making. And investors are really trying to observe something when they're giving you feedback and they're meeting you. It's how do you behave when you're under pressure? Do you communicate clearly when some of the outcomes are not clear? How do you respond when you're being challenged or with difficult questions? And what do you like to work with? Because it's not usually one meeting dictates everything. There might be several meetings, several follow-ups, and your behavior over that time tells the investor a lot about you and fundamentally what the business will be run like.
I think we've got some quite interesting statistics to look at next. Be interesting to have you give us a little bit more of a perspective on these.
Yeah, I think the one that always maybe surprises people is the 1% number. You know, 1% is generally a figure that's, you know, there or thereabouts of how many startups actually raise venture capital funding, which is what we're going to talk about mostly today. And that's pretty scary thought. You know, if you were logical, it would put you off. It would scare you. It would make you worry. But actually, founders need to think beyond that. They need to understand the reality of the statistic and be determined that they're not going to be the 99%.
The 99%, yeah.
Yeah, and what they can do in terms of the business, the idea, the product, but also their own behaviors during the fundraising process to help improve their chances. And again, the investors are often making these decisions over the first meeting, the first couple of meetings, and a lot of it is based on behavior and traits they see in the founders, not about the numbers or the projections or the market size.
And have you ever kind of found that that constant pressure has negatively impacted kind of your own performance and decision making? Have you got any interesting stories to tell us?
I am 100%. I've been in fundraising processes where I was assisting a founder, and every meeting we had, some of the feedback the founder would take sometimes too literal, and almost start changing the business plan or pivoting the product based on that feedback, which is sometimes very dangerous. Because yes, you want to listen and absorb and learn from the feedback of the investors, who are usually extremely educated and smart people, especially around their areas of knowledge. But at the same time, if you constantly change and pivot your idea, you don't you don't give the impression of someone who has thought an idea through, who can stick to a plan, who can back their own conviction. So it's
Mhm.
finding that middle ground that will first of all keep you happy as a founder, and that's something really important. What are you believing in? What is your conviction over the way you're going to run the startup and what you're building? But also being able to take that feedback from investors to maybe slightly change, improve, adjust, etc. That's a hard balance.
Yeah, yeah, I can imagine learning how to kind of adapt without losing that clarity of your overall vision and what you're presenting. Because if you lose that, I can imagine then the investors are going to be like, well, if you can't stay on track, then they're not going to want to stay on track either.
Yeah, and I think it's also important that we recognize venture capital, the way that they make their returns is often making relative number of big bets, and they only need one or two to come off. So a lot of their decisions won't come off. They'll back startups that won't turn into multi-billion pounds exit, and therefore you have to take that knowledge and say, yes, they are giving me feedback, they I want their money, but they also make mistakes. They don't know what the future holds. How do I convince them to come on the journey with me and show them that I can be adaptable, yet quite strong in my conviction, etc., etc.
So moving on now, just talking a little bit more about what I've often heard referred to as kind of the emotional roller coaster.
Yeah, it really is. I mean, building a startup is, and fundraising, which is a big part of building a startup, is equally one. And rejection is normal. You know, if you've ever tried to build anything from scratch, you'll often have people who doubt you, who say it won't work. That could be family and friends, it could be colleagues, it could be customers, it could be things you've read in the media. And again, you've got to be able to take that and almost have the resilience to say, I understand, but I'm fully in. I have belief. So rejection is part of the game, as is the case when you're sitting in these investor meetings. So you have to be ready to be ignored, ghosted, be told by people, I don't think I'm going to invest. We've seen how that kind of on TV with Dragon's Den, how it affects people. That's a big reality. So be prepared for it. And if it doesn't come, then fantastic, but it mostly will come.
I'm glad you brought up
And
Dragon's Den.
yeah,
That's
yeah, it is. It is very
yeah,
much.
I love watching that.
And what the investors are looking for is founders that listen, that adapt to their feedback, maybe adapt to what's happening in industries, people that stay emotionally stable, because you're going to get a lot of rejection, a lot of challenges. They want to see how you handle that in meetings and in follow-ups. And they want to see that it's somebody that can take a hit and get back up again. They want to see preparation, which ties into confidence. Someone that comes ready with questions. Again, with Dragon's Den, how many times have we seen the dragons ask a question, and if the founder doesn't quite have the answer and they expect them to have the answer, it really knocks their trust and confidence in that founder.
Can derail the whole thing,
And can
especially when they're asking for figures. That's what I've noticed when they ask for figures and the people don't have figures.
absolutely,
Great visions, but nothing to back it up with.
yeah, absolutely. And so in high growth startups where investment is such a key part, they look for all of these traits all the time, to give them confidence that you're going to go on this journey with them. And the journey is often for several years. So they have to feel that they can, get in your boat and go on this journey with you.
I mean, I'm probably biased as kind of a marketing and PR specialist. Obviously, communication is an absolute priority. I mean, from your perspective, can you talk us through a little bit more about why communication is so important, and maybe what mistakes you would say are kind of common when it comes to communication and fundraising?
Yeah, I think this is probably the most important part. No matter how good the product, the team, the market potential, etc., is, unless it can be communicated clearly, it's very difficult to get the message across. And investors will often cite that, because if you can't communicate it to the investment community, how will you communicate your value proposition to your customers? And your customers will ultimately decide whether you're a successful startup or not, because at some point investors will want to see revenue. So it's very important. And investors are people just like us, and we know that our attention spans are pretty low. So one of the big things I always say is decks in meetings should never be more than 10 slides, right?
Okay, interesting.
10, or, because we don't remember the slides that we're being presented often. Here it says the investor, the attention span is 2 minutes 24. It also usually, the first few slides are the ones where investors make a decision. Not necessarily are we going to invest in you, but sometimes they'll say, I'm not going to invest in this person. And
yes, or are they open to listening to more?
Correct. It'll grab their attention or it won't. And they are often, again, the reality is an investor will often meet 20, maybe up to 30 people a week pitching. So you've got to realize that they've seen, this is not their first rodeo. They're constantly being shown super exciting, super interesting concepts by great people. So the communication part is really important, not just from the start, but continuously through the process. So they are looking for clarity. They're looking for information quickly. They're looking for information that's confidently delivered. And they're looking for strategic information. And actually, again, sometimes people think investors, super clever people, we're talking about technology. I need to really deep dive on my technology and everything around the infrastructure and how it's built. Actually, when you're pitching, often simplicity and clarity is more important. What is the product? What is the problem you're trying to solve? How are you going to solve it? How are you going to create a business out of that? And diving into the technical, whilst they might ask for it at a later point, certainly in the first 1 or 2 meetings, decisions are not made based necessarily on the technicality of what you're building. You need to convince them that the problem exists, that you have a solution, and you are the people, the team, the founder that can go and build and grow this solution. So they want to see leadership, market understanding. They want to see structured thinking about how you've come about to your decision on how you might get into 100 million revenue in 5 years' time. How do you explain the problem? How do you explain the solution to the problem? We spoke about this last time where we talked about they like founders who understand the sectors that come from those sectors, because then they have a real understanding of what problems they're trying to solve. And within all of this, communication is super, super important. And again, just to make the point, not just in your first pitch or second meeting, in your emails, in your follow-ups, etc.
And I'm just going to open the floor to our attendees just to see if anyone has any questions they would like to ask around this. I don't know if there's anything you'd like to know more about how to demonstrate good leadership, or ways to show that you can be adaptable to feedback. But if anyone has any questions, please feel free to pop them in the chat, and I can pick up on those in just a moment. And just we'll carry on, Daniel. Would you say there are any kind of common mistakes that founders make when it comes to kind of the way they communicate?
I think certainly, as I said before, sometimes being over technical can be an issue. Certainly over promising. So sometimes trying to bulk the numbers up in terms of what you can achieve, etc., can be a very bad signal to investors. Again, they've seen many people pitch, so they understand. Lack of confidence, really, and desperation can sometimes be a real indicator, which is not always obvious to how you convey that you're not desperate. But at the end of the day, when you're trying to pitch for investment, you want to get money, and you want to do it as quickly and as easy as possible from the right people. So finding all those balances is really important.
And I mean, looking at kind of this particular slide, what do you think you need to do to stand out when you're trying to raise funding or present your ideas to investors?
I think sometimes people try and stand out too much, and what I mean by that is, first, you need to be reflective of who you are and the type of company you're trying to build. Honesty and transparency, and actually, this goes back to the previous slide of trust. If you're presenting something on the screen visually that's very different to the individual you are, they're going to see through that. So the package has to be right. What's the product you're building, who you are, what's the personality you want to reflect, how you are going to be as a CEO, founder, etc., and what that looks like on the screen is first and foremost the most important thing. And I think they investors evaluate loads of different traits, but one thing that always stays there at the beginning is, do we believe this founder or founding team are capable of growing a business from 0 to 100 or even beyond? And do we have trust in what they do? And that trust comes from repeated actions. It may be a follow-up that you said you would deliver. It may be that they asked you to look at a different go-to-market strategy, and then how do you respond to coming back to them once that's been discussed? Timekeeping to some people. All these kind of things build trust. Slides don't. And I think, what are they really evaluating? Everyone comes to them with big ideas in big markets with big revenue potential. So they're used to seeing all these things and financial projections. And they know that if they take a meeting with you, they probably believe in it. But they know that all of those things will change, especially projections. So what they're really looking at is you as an individual. How investable are you? And that might be around your leadership. It might be around emotional intelligence. It might be around communication, very much communication, adaptability, decision-making, showing them how you've decided on product and features, and they might be asking you these questions to test you. And I think most importantly, long-term thinking. Because even though we see these overnight successes, or what seem to be overnight successes, or companies that raise millions and millions after 1, 2, 3 years, investors know that exits typically come from a much longer journey. So they're in it with you for 5 to 10 years stretch. They want to see that you're thinking that far ahead. Not because you can predict the future, but they need to see that you're a strategic thinker about what the future might look like. So they're looking at all of these reasons. And by giving them the impression that you're able to think and communicate and behave emotionally around these things, you're building trust. And if you don't build the trust, you'll be a perceived risk, which is where they might choose not to put the money, which is a bet from their side. The bet might not come to your startup if they can't have the trust that you'll deliver.
It's interesting the way you say it's a bet, a gamble. I never really looked at it like that. I always thought of it as a very strategic process. I never thought about it in the sense of, you know, that they're betting on multiple opportunities.
I would say, yeah, it's a good point. I would say it's super strategic because investors, especially ones that are specialists in certain areas, they'll have beliefs and foundational thinking around what the future might look like. So now they might be thinking around AI. What will the future look like in the world of productivity, HR, etc.? That'll form the basis or the thesis for what they want to invest in. But where the bet comes in is that they could put their money into lots of different startups. And because they'll often see lots of great ideas, sometimes similar ideas, they are making a bet on the individual. And which individual gives us the greatest confidence that in 10 years' time, they will deliver an exit, which is where we get our big payback. And from that perspective, it's a bet because there's so many things that are unknown during that 10-year journey. And that's why it is essentially a bet, especially when you think that out of 10 investments, they'll rely on one or two to give them the exits that pay back for all of the other investments.
And I know we've talked, we've touched on this a little bit already. You were saying about kind of worrying too much about the technical side of things, and you mentioned about appearing kind of too desperate as well. I mean, maybe you could talk us through just a little bit more about the mistakes that really do break investor trust.
Yeah, I think one that's really important is, and this is probably for any meeting you have with a customer or a partner, etc., you're having to build a relationship with that person. And talking is important to convey your message, but listening is equally important. The investors are people who are super smart, educated, know markets, they see a lot of different things. So actually, I always found that going into these meetings and almost treating it like a dual approach. I want to convey information, but I also want to ask the investor questions. The questions might be around the market. Maybe I can learn something from the investor. I believe the market will do A. What does the investor think? And can I ask them the question? Show an interest in their thinking. That might give the impression, quite rightly, that I want them to also play a part in my thinking, whether it's validating it, whether it's challenging it, or whether it's disagreeing completely. So listening is usually very important. And I also believe that comes with asking questions. Founders like, excuse the celebratory background, I'm not sure where that came from. Founders like, investors like people that are curious because they know that there's so many unknowns in the journey of startups. So asking a question isn't a sign of a weakness, rather it's a strength. So ask questions, listen to the investors intently, especially if they're telling you something they might disagree on, because they might want to see you acting on that. And I think overall, whilst what we see on the news or in our LinkedIn feeds is sometimes super brash, media ready investor personas, actually, investors often like, especially in the investment process, realism, clarity, discipline, transparency, and clear thinking. They're not looking for necessarily superstars, because again, they want to feel they know this is going to be a long journey. It's those maybe slightly more boring traits, if we can call them that, even though they're not, that give them the confidence and trust to say, I could work with this founder and this founding team.
Yeah, that makes so much sense. I mean, you're not auditioning for Britain's Got Talent, you're in a fundraising process. So it's about building that trust and belief in what you're presenting to them, not about kind of the performance so much that you put on yourself.
Absolutely.
And you know, while we all love to hear a success story, it is good to know kind of a little bit more about why fundraising can be unsuccessful. Have you had an experience like that, Daniel?
Absolutely. I worked with a founder where we were bringing a product very early to market, which was around agentic AI into the world of e-commerce. The product was extremely technical, super clever. And one of our mistakes was that because it was agentic AI before agentic AI was really spoken about, and the founder was super technical, when we were pitching to the investors, we focused a lot on this and probably sacrificed the time we spent with the investors, um, and didn't really give enough attention to things around going to market, how we're going to build a pipeline of sales, and I think that in the end hurt us. We thought we were focusing on a strength, technical strength, um, whereas whilst they loved the idea from a technical perspective, and also sometimes we deep dived on the technicalities in meetings where we just lost people's attention.
Mm-hmm.
So I think the founder and I tried to impress them with our technical ability, or certainly his technical ability, but we just completely lost them. Not that they didn't care, but in a half an hour meeting, this is not what they wanted to learn. They didn't want to understand how the infrastructure of multiple AI agents was being built. And I think that was a mistake that we made. And in hindsight, we would have pitched it slightly differently moving forward. We were constantly commended on the technical ability, but challenged and lost confidence in the commercial ability. And remember, because investors are meeting a lot of different companies and they move at pace, they want to move at pace, they want to take their money and spend it. They don't always give you all this feedback so that you can go and improve and correct yourself. So you have to have the ability to read signals during meetings and during maybe lack of response to understand why the investors are maybe interested or not interested or going a bit cold, to try and improve that process and that fundraising journey.
I mean, that makes a lot of sense. And yeah, I mean, that's certainly touched on what may get missed by founders when they're trying to raise investments. I mean, maybe you could talk us a little bit more through the process of fundraising and other things that founders may miss or may do in the wrong order, almost like you mentioned about in the first few meetings, maybe you got a bit too technical, whereas that was your opportunity to build trust, build interest in what you were presenting. And so that would have been better off later on down the line, is my understanding from what you just said.
Yeah, I think some of the realities around fundraising, and 1% raise the money, the other 99%, most of those won't even get the meetings. I think this is a real reality check. Getting your foot through the door to have the meetings with the investors is often the hardest challenge, especially if you haven't done it before and don't have the network, because the venture capital community is a relatively small community, and they all know each other. Once you've been in that environment, whether you're working in a company that's raised money, etc., you might have a network, but otherwise to get in front of them is very difficult because they're just bombarded and inundated with pitch decks. So I would almost say the process of fundraising, which might shock people, typically will take 6 to 12 months. Some will be quicker, of course. So within that
a lot longer than I thought, I must admit. I didn't realize it was that long.
And sometimes the first chunk of that, maybe 3 months, is purely trying to get in front of the investor, even to have your first meeting, because these guys don't know you. So this is where you have to try and get in front of them. So the first part is almost build that network, start as early as possible. If you know that you want to go and speak to the VC community, get to know them, whether it's LinkedIn, whether it's events, whether introductions are much better from other founders and people you might know in the industry. Because when you're ready to go and speak to them, be prepared that you might have to spend several weeks to actually get in front of them. And once you go in front of them, you then have to be prepared with a full not just pitch deck, but raft of documents. People call it a data room. So your data room of financials, of plans, of hypotheses around business, technical roadmap, all these lots of things need to be ready, or certainly thought of, because once you start speaking to investors and you have interest, momentum is key. It's a momentum game. So you want to fast track that by being ready to come to the market. And when when the market responds, you want to be able to move quickly. So again, I think most people find it quite maybe interesting that it does take that many months. And the other thing that I should add, because it takes that long, and it's a pretty relentless process, founders I've worked with have often been taken aback by the fact that they have to allocate more than half of their time to the process. I would say sometimes even 80% of their time to fundraising. So you have to manage the fact that suddenly you're 12 hours a day. How much of that can you spare to fundraise versus running the business? And that's another real, I would say, challenge, but something that people should be prepared for, because the fundraising process is relentless and can take long and requires total commitment and unwavering dedication, because only 1% get funded. So
Yes.
if you're not going to plow 7-8 hours a day to trying to get that money, someone else might do.
Somebody else might. And I mean, we often hear the term imposter syndrome. I think it'd be important to maybe touch upon that a little bit, and how that fits into the fundraising process, especially with having to put so much time into that side of things.
Yeah, so I think the emotional toll that it can take, not just the fundraising, but also running the startup, is real and very difficult, and it challenges you in lots of different ways. And imposter syndrome is just one of those things. You're launching something from scratch, or maybe with a little bit of traction. You're going to ask for some substantial investment from someone, and you're going to speak to them like you know exactly what's going to happen, with confidence, clarity, strategic thinking, etc. When the whole time you do feel an imposter, because maybe you haven't worked in this category before. Maybe you haven't built a multi-million, multi-billion pound or dollar company. Maybe you haven't been a leader before, and here you are trying to convey all of that. So at all of these occasions, you're going to have doubts about the things you say, the things you believe in, your own place within this vision, this company. So it's a real thing, and it happens to everybody. I think a lot of people speak about it, which is great, because I think it is something people have to be aware of. And you have to, again, the investor knows that you don't know everything, and they know that you have doubts. So being able to give that confidence and that air of trust, but at the same time, I think being, let's say, real and honest about the fact that you are only human and you can make mistakes and you can get things wrong, is something that an investor knows, but they sometimes like and appreciate to see humility and maybe confidence, but with an asterisk that says, yeah, I will need help. So
Yeah.
and again, don't forget, going in and asking for someone's money is actually part of the request. You're also asking for their help.
Yes.
Because a good investor will not just give you their money. They'll give you their experience, expertise on particular markets and processes. Maybe they've seen other portfolio companies grow, so you'll want to pick their brains at several times through the process. So they are there to help you, and so showing that inclination and willingness to ask a question, take their answer, value their opinion, isn't just good because people like to be listened to and appreciated. It's good because they might know more than you on certain topics. So the imposter syndrome is something that happens daily to founders. Their ability to act under that pressure and that feeling of not being in control, and being out of your comfort zone, actually their ability to react under those conditions is what, first of all, sets apart the really great founders. And I think investors want to back that.
And one thing that interests me is, how do you kind of stay in control of your actual startup during the fundraising process? Obviously, I know you said about dedicating so much time to it. Are there any other ways that you can stay in control to prevent burnout, to prevent you feeling so overwhelmed by everything?
I think there are lots of ways that I've seen founders do it, and I try and do it when I'm in startup mode. If you have a team around you, then that's great. Be transparent with them. Let them know the journey you're gonna go on. If you're heading up that fundraising process, you might need their support. You might need them to muck in and help with certain aspects of running the business whilst you're in this mode. So it's important, again, to be transparent and clear and human with your team. And I've seen that work really well, because the guys who are with you in the early part of the journey, if they're the right type of people, they'll jump in and help. And they'll be a huge pillar of support. Of course, outside of work, family, friends, other founders, communities of founders often support each other because they know what they're all going through. So having that structure around you from a human perspective is a huge help. And I think something that always helps me is just remembering that all great startups have been through a similar thing, right? The guys at Airbnb were rejected hundreds of times, and look what they built. And often, if you read their stories or quotes, the first, not just the fundraise, the first several fundraises, the first several years were constant flip-flopping, not knowing where the business is, having doubts about the business, and their ability to navigate that, even though it wasn't always easy or rosy, is what made them great founders that ultimately achieved success by building sustainable businesses. And I think even recently, one of the founders, it might be at Airbnb, said that even when the company was multi-billion revenue, he felt incredibly lonely. And that's because there is this constant stream of things that have to be decided, decision-making, imposter syndrome, doubts, not knowing, success and failure can feel very, very immediate and extreme in the world of startups. So being prepared for that is having structure around you, being able to always remind yourself other startups are experiencing similar things, even ones that have raised a lot of money and have teams. So I think that's always useful, to actually know that you're not the only one that's feeling the challenges of it, and actually putting things in place to help you cope with it. And cope, you said the word burnout.
Mm-hmm.
I don't know anyone that's been able to launch something great from nothing and raise money without some element of burnout. So if you know that's coming, how do you handle that? How do you prepare for that? What do you need around you, etc., is important to prepare for and think about, because it's going to be a journey, a fun journey. I must say, I think usually pitching for fundraising is super exciting, because people show a genuine interest in what you're building, and you're able to have dialogue, build relationships, and hopefully get the money, which is a very exciting feeling. It almost feels like a new start to your chapter when you're able to secure your first investor or multiple investors. It is a very exciting thing, and I think keeping that at the forefront of your light at the end of the tunnel is great to keep you motivated and energetic.
That's really helpful. I've certainly something that I've experienced myself with burnout. It's very easy to kind of go all in and not pace yourself, and not realize that it is a longer term journey. so to speak. You know, it's not a race, it's a marathon, as they say. And I am going to open the floor again to any of our attendees. If you have any particular questions that you would like to ask Daniel, please feel free to pop them in the chat, and I can obviously read those out to Daniel. And until we kind of get some more questions from the audience through, are there any key kind of takeaways that you feel when it comes to the emotional side of fundraising that founders need to really keep in the forefront of their minds, Daniel?
I think one of the key takeaways I always see is, even though there are traits that people look for, and you should know what those traits are the investors are looking for. I think investors see when founders are trying to act in a certain way, and maybe it's not representative of who they are, and they'll see that in the multiple processes. So I've raised with lots of founders who have been very different characters, very different personalities. Some have been great communicators, some have been not so good. And whilst, again, they had to work on their communication, I think it's important to pass across your personality, because investors want to work with people that they, of course, trust, they have confidence in, but also people that they like. So being able to almost take all of this information and pressure away and saying, actually, I'm having a conversation with someone, I want to know what they're like, and they want to know what I'm like, and bring it to that informality sometimes, where you can bring your character and your personality out. I think that usually helps, because the truth is, if you're the founder of that business and you're going to run that business, your personality, your character will run through the veins of the business, and therefore being honest, transparent, and whilst you might try and polish up on certain things, being yourself is important, because you want the investor that also wants to work with you, and that's where you see the best that's where you see the best relationships between investors and startups, where they knew what they were getting involved with from a personality perspective, and good or bad sometimes, and that worked in terms of creating a very long-standing relationship between them. So I think that's important. You know, be yourself, even though you might want to be a polished version of yourself at times, or things that you're not as confident on. Be yourself and be prepared, and don't let the rejection get to you, because it will happen and it will come. Stay confident and you know, listen, learn, adapt, but don't let the no's get in the way of your energy and your excitement to get the fundraising process underway and hopefully complete as soon as possible.
Well, thank you so much, Daniel. I've certainly learned a lot today, and it's been a really, really enjoyable webinar. I'm really looking forward to the next one. So I hope to carry on with this process, talking about everything we need to know during the next webinar. I believe that's looking into kind of maybe a little bit more into the fundraising side of things, and what people need to know more about getting more prepared for that. But I do appreciate everything you've shared with us today. And if you do want to know when the next webinar is, then just follow us at the London School of Emerging Technology. You can also follow us on Facebook, LinkedIn, Twitter, YouTube. So all the normal places we can be found on if you want to find out when the next webinar is, and have a look at some of the courses that we're offering as well. I will say thank you to Daniel. I'm going to let him go, and look forward to seeing you next week, Daniel. Do take care. I hope you have a great week, and good luck with any fundraising journeys you're on.
Thank you, Annabelle, and good luck to everyone.
You're very welcome. So just a few things. We do have some events kind of coming up. if you have a look at our website, you'll be able to see the event calendar and check out some of the events that we have coming up. So we have an interesting one coming up in September, which is about artificial intelligence essentials. So understanding and exploring, experiencing kind of AI in just 1 hour. So looking forward to having you with us at the next webinar. I hope everyone has a fantastic week and the best of luck with anyone who's on a fundraising journey. Thank you so much for joining us today and have a fabulous